Good afternoon, everyone. Thanks for joining us. We're just going to wait a few more minutes to allow people to finish logging in, and then we'll get started shortly. Good afternoon, everyone. I am Andy Umbach, financial advisor here at Pulse Financial Services, and welcome to our economic and market update for the second quarter of 2025. The U.S. economy entered 2025 with solid momentum, and however, tariff whiplash and equity market correction and weakening economic data have sparked fears of a possible recession and resurgent inflation. Businesses have continued to expand payrolls at a healthy but albeit slower pace, while consumers have pared back on some spending. Moving forward, what matters most is whether the weakness in consumer and business sentiment persists, intensifies, or translates into further slowdown in spending activity. The U.S. economy entered 2025 with solid momentum, but with this, there has been a lot of uncertainty around certain trade proposals, tariffs suggested, and then whipsaws along all that. Inflation eased in February and then again in March, and we saw some pullbacks from higher, more expensive parts of the market as well. And policy certainty turns into policy consistency, both with risks in the economy and the markets remain. The guide to the market is built to illustrate economic fundamentals, and we certainly went through this and have updated some of these slides because the information on this is changing rapidly. So certainly we hope you find this information valuable. The market itself, or the guide itself, is about 90 slides, so we try to boil it down to just slides here, 12 slides here that we think you'll find most of interest. As I mentioned, coming into this year, the economy looks strong and all momentum appears to have faded during the quarter. To understand why it's still been so resilient, we can analyze these different components of the GDP growth. Page 18 of the guide offers a closer look at the key drivers behind recent GDP growth. Consumption accounts for about 70% of the US economy. It's no surprise that the health of the economy is closely tied to that of the consumer, supported by impressive gains in household wealth and 22 months of positive real wage growth. Consumer spending has powered the economy forward, rising 4.2% during the fourth quarter. Business fixed investment slowed after a string of strong prints, likely reflecting the lagged impact of higher interest rates, while residential fixed investment improved after two straight quarterly declines. The recent decline in mortgage rates and suppressed level of housing starts in 2024 suggests that there is some room for revival in the housing market, but a sudden plunge in immigration could impede housing demand and building activity moving forward. Government spending has helped boost growth in recent quarters. That said, budget cutbacks could limit any meaningful support from federal or state or local government spending in the months ahead. And as I mentioned, policy uncertainty is casting a fog on the economic outlook. Recent data have shown a huge spike in imports, likely driven by businesses trying to front run some of these tariffs. Should imports remain elevated, it is possible that we get a negative print for the first quarter of 2025 GDP, because those imports can be a drag on that figure. On top of that, weaker vehicle and retail sales through February point to a sharp slowdown in consumer spending from its booming fourth quarter pace, while consumer confidence recently fell to a multi-year low. With policy uncertainty weighing on consumer and business sentiment, it is clear that the economy has slipped into gear. That said, it is unclear if the slowdown is the start of a moderation back to trend growth or the beginning of something more challenging. The unemployment rate has stabilized near 4% for the better part of last year, at 4.1% in February. It's meaningfully above its cyclical low of 3.4% set in April of 2023, but is still lower than it has been 90% of the time over the last 50 years. We view this unemployment rate as a normalization for the economy operating above full employment. At this year's progress, job growth could slow alongside economic activity, but should still remain positive. Layoffs have remained low, but any meaningful increase could pressure unemployment higher. Although lower labor force could, growth due to more restrictive immigration policies could help offset this. In fact, if the economy activity holds steady, unemployment might even drift lower over the course of the year. Loosening labor market slack would allow wage growth to moderate. After peaking at 7% in March of 2022, wage growth has slowed back to trend, with wages for private production and non-supervisory workers rising 4.1% year over year in February, just above the 50-year average. While slower immigration could put upward pressure on wages, sustained strong productivity gains should help limit any pass-through for this inflation. The S&P 500 earnings grew 10% in 2024, capped off by an impressive fourth quarter earnings season that we saw earnings rise about 18% year over year and 5% quarter over quarter. Margins were the key driver here, contributing over 13 percentage points to overall growth. Beneath the surface, earnings continued to broaden with the S&P. In fact, 10 of the 11 S&P sectors contributed positively to earnings growth, led by financials. This trend should continue to broaden in 2025, so we should see a broader market. Analysts are projecting even stronger growth of 11% and 14% in 2025 and 2026. However, earnings are cyclical, and compared to the long-term average of 7%, these estimates seem a little rosy, so setting the bar pretty high, particularly given our expectations for slowing nominal growth. Normalizing GDP growth could limit revenue growth, while rising input costs from tariffs could pressure margins despite corporate tax cuts. So it's going to be a real balance between, okay, what happens to the corporate tax rates? What's the higher input cost for some of these tariffs? Against a backdrop of increased uncertainty, markets are already very sensitive. Companies that fail to meet expectations may be punished more than usual. Oftentimes we say, earnings are based on better than or worse than, and not necessarily actual number. So if the expectations are high, that could be a challenging bar for companies to leap over. And some of these companies could be more susceptible to market sell-offs. This is a chart we just recently updated because we got some figures through March. The headline, inflation components. This shows how rampant inflation was when we were really printing a lot of money for the government, and then we've slowed that as we reduce the money supply. So that's been positive. And this compounds, so this keeps growing. So, inflation was 5%, then you stack it with 7%, and then you stack it with 8%. So that's why we saw the cost of really most everything go up quite a bit. But the consumer price index for March increased by 2.4% year over year, which is down from 2.8% here printed in February, making it the lowest annual rate since September of 2024 and signaling a notable slowdown in inflation. On a monthly basis, headline CPI actually fell by 0.1%, following a 0.2% increase in February. And core CPI, which excludes volatile food and energy, rose by 0.1%, the smallest increase in 9 months. The major contributors to inflation were food. Eggs stood out. They were the highest, cost contributor of inflation in the food area. Personal care, medical care, education, apparel, and new vehicles also went up. Motor vehicle insurance also up 7.5% year over year. So this is a significant contributor to the transportation sector. Some of the offsetting factors, what detracted from inflation, reduced inflation, energy. So the energy index fell by 2.4%, about a 6% drop in gas prices. Core goods dropped as well. Transportation, notable declines in airline fares, and car and truck rentals dropped. Used cars and used trucks also saw a decrease in their pricing. So a mixed bag there, but overall positive move for inflation. Certainly over time, economic globalization has led to increasingly relaxed trade policies. Indeed, the average tariff rate on U.S. goods imports has steadily fallen since the 1930s. However, geopolitical tensions and supply chain snarls induced by COVID-19 have prompted a reevaluation of open trade policies and America's manufacturing vulnerabilities. with promises to protect American businesses, to protect Americans from the vulnerability of dependence on other nations to make everything and address these unfair trade practices. Tariffs sit at the center of the Trump administration's policy agenda. Certainly, the word of the year is tariff, I'd say. Page 31 of the guide helps put some of the recently imposed tariffs into context through the end of March. So this figure changes, every day it seems what the actual tariff rate will be on who and on what. But considering the tariff rates that are already in effect, we estimate the current rate on the U.S. imports to be about 6.4%, which would be up from 2.5% in 2024, and the highest rates that we've seen since the 1970s. Admittedly, U.S. trade policy remains very uncertain, and it's unclear what tariffs will be implemented, like I said. But decoding some of these tariff motivations and implications, why would we want these tariffs, or what is their reasoning for some of these tariffs? A couple points are decoupling, so it shifts supply chains, reduce resilience or reliance on certain countries. Another reason for tariffs would be for rebalancing to reduce trade deficits, boost domestic production. As a negotiating tactic, that's what it seems to be about, in large part, just negotiating using economic pressure to achieve policy outcomes. And then it also is for funding, so it generates revenue to fund the budget priorities. So that's, you can see historically where tariffs where Trump in his previous administration increased tariffs here, and you can see that they maintained those tariff rates just for that extra revenue to come in. The labor market has normalized from its post-pandemic boom, but job growth has settled into relatively healthy pace. That said, the Trump administration has expressed its intent to meaningfully reduce immigration, which could have meaningful implications on the labor market in 2025 and beyond. After falling sharply during the pandemic, labor supply in the US staged an impressive recovery, largely due to increased immigration. In fact, of the roughly 10.6 million individuals that joined the labor force from January 21 through January 25, 54% of them were born outside the US. With a surge in foreign-born workers, employers were able to fill open job openings without applying upward wage pressure to wages, helping to explain why job growth hasn't sparked higher inflation. However, restrictive immigration policies could hinder labor force growth, especially given weak domestic demographics in the US, and potentially lead to higher inflation through higher wages and slower growth. The impacts of these policies can already be seen. Southwest land border encounters plunged to under 12,000 in February, compared to an average of roughly 100,000 per month in the fourth quarter of 2024, and over 250,000 per month in the fourth quarter of 2023. Separately, reducing the size of the federal government and freeing up those people to join the private sector, and a strong recovery in the labor force participation rate has boosted labor supply, while the continued aging of baby boomers into the retirement years has left the overall labor participation rate below the pre-pandemic levels. Participation among prime age workers has fully recovered from its pandemic losses. Moving forward, employment growth is likely to slow throughout 2025, but solid corporate profits should keep it from collapsing. However, severely curtailed immigration could provide stagflationary impulses, depending on how some of the other AI or labor force participation rate settles out. Among other expansionary fiscal policies, the Trump administration has expressed its intent to fully extend the Tax Cuts and Jobs Act, or the TCJA, reduce the corporate tax rate, eliminate taxes on tips, Social Security, and overtime pay. They also promised to drastically cut costs. And determining whether these policy proposals are feasible and how they could impact the fiscal health of the U.S., page 23 of the guide is nice and helpful. The left chart shows the Congressional Budget Office estimates for government spending and how that spending will be financed in 2025. So this is, a chart I review with many of you during our reviews. It's just the total amount we're going to spend as a country. We're going to spend about $7 trillion. In ballpark, we're going to bring in revenue of about $5 trillion. So that's where we have that $2 trillion deficit, or they're showing about a $1.8 trillion deficit. And then these are all the different sources of the financing, how much comes from income taxes, how much from payroll taxes, how much from corporate taxes. And then you can see this sliver there, which would be from the actual tariffs, and then how much we're spending. So initial efforts by the newly formed Department of Government Efficiency focus on federal workforce reduction to cut costs. And while the extent of the federal layoffs is still largely unknown, their cost savings will likely be negligible. We estimate that less than 6% of the budget went for federal employee compensation in 2024. Some of you may have heard that the DOGE, the Department of Government Efficiency, is trying to cut expenses by $1 trillion, and then the Treasury is trying to raise revenue by $1 trillion. So if they were able to do that, then they'd have a balanced budget. A big part of this, total spending, which is something to focus on, is this net interest expense. You can see it's close to $1 trillion. So that's the interest on our government debt. And Treasury Secretary Scott Bessent has said that for every basis point, so 0.01% for every basis point, the 10-year government bond is reduced. It will save about $1 billion in interest costs for the federal government. So this figure is based on the large volume of U.S. debt that needs to be refinanced. About 25% of the 36 trillion national debt needs to be refinanced this year. So every reduction in interest rates is very meaningful. So currently the 10-year government bonds around 4.3%. It was around 5% to start the year, then it went down below 4, and now it's back up to 4.3. So about like that 0.01% saves about $1 billion on interest costs. So moving from 5% down to 4% would save about $100 billion on interest expense. So that's a huge focus of the current administration. The administration has also expressed its intent to use the tariff revenues to offset, some of the reduction by the Tax Cut and Jobs Act. This chart I think is interesting too, and this shows, what all the years that we spend more money than what we have coming in. So we're operating at a deficit, so we're spending more than what we have coming in. Just during Clinton's era here, we actually operated at a surplus. We saved more than what we spent, and then you can see some of these deficits coming out of 08, 09, COVID, and then the projected deficits going forward. So certainly they're going to have their work cut out for them to reduce some of the spending and expense. And now you can see for yourself exactly how it all lays out. And here's kind of the other chart that I was talking about, the interest rate expectations. So this is the federal funds rate expectations, the Federal Open Market Committee, they put out this dot plot, and then there's the market expectations in green here too. So the Fed's kind of in an unenviable position where they need inflation to drop. Are these tariffs going to create more inflation? They potentially could in the short term, especially. So they're wanting to reduce interest rates. Inflation's coming down, so that's positive, but the outlook is kind of cloudy around some of this unknown. But today's the markets are pricing in just under 3 full rate cuts in 2025. This likely reflects an average of 2 scenarios being weighed by investors. Should inflation remain elevated and the economy resilient, the committee could just deliver 1 or 2 cuts this year. On the other hand, a more serious growth downturn could prompt more aggressive rate cuts. All that said, the ultimate impacts of government policy are still unknown, and the pace of these rate cuts will still continue to hinge on the economic data as well. After an impressive rally in 2024, fears of an economic slowdown forced investment grade and high yield credit spreads modestly wider during the first quarter. Even still, both sectors are up over 1% so far this year, and spreads continue to look tight relative to history. This tells us that corporate credit or corporate debt market is not overly concerned about the looming recession. On slide 37 of the guide, we show corporate credit spreads over time and compare the current spreads and yields to the long-term averages. Despite the recent spread widening, valuations in both sectors still look expensive. That said, we think investors should embrace credit for the attractive overall in yields. Spreads could widen further from here as economic momentum fades. However, corporate credit is better prepared to weather a slowdown today compared to previous cycles. The credit quality of the high yield markets has improved since the great financial crisis as well. And with the outlook for monetary policy, government policy, and the economy still largely uncertain, it's difficult to make any outsized bets on whether you want to be long-term bonds or short-term bonds. For those searching for higher yield or higher returns, corporate credit offers attractive opportunities. That said, not all bonds are created equal, and an active approach to fixed income investing will be key to finding attractive value and navigating some of this turbulence in what will be in the market. Despite the strong earnings outlook, elevated uncertainty at elevated valuations is a significant risk for U.S. equities. So this chart, we review this as well, and this shows when the market's very expensive. This is the PE ratio some of you may have heard of. So this shows when the market's very expensive. This shows when it's average price, and this shows when it's cheap. And the best time as a buyer, of course, when things are cheap. These are also the scariest times to buy when the markets, might not be looking so good. Right now, and even recently, the market's become less expensive, but it was still very expensive. So we've let a little bit of air out of that balloon. But, when we're dealing with all this uncertainty and an expensive market to start, that's where we see some of these downturns occurring. The Mag 7, the Magnificent Seven, are responsible for a large portion of this distortion. These companies are profitable, but they are also very overvalued, overowned, and overly large portion of the S&P 500. While many of them could certainly benefit from AI, technological change is unpredictable and disruptive. What's interesting is through the first quarter of this year, the S&P was down about 5%. The Mag 7 was down about 15. So a lot of that pulled the S&P down, and the S&P excluding the Mag 7, so the other 493 companies in there, was actually slightly positive on the quarter. So elevated valuations, especially of those more expensive sectors of the markets, it's important to have maybe the more value oriented or the less expensive parts of the market, and those areas have been much less impacted by this recent downturn in the stock market as well. Proposals for tariffs, taxes, and deregulation have yet to crystallize into policies, and the opposing effects on profit margins are difficult to untangle. Obviously, AI and policy are driving U.S. markets, and the destination isn't clear. As such, investors should ensure that their portfolios are not overexposed to the most overvalued parts of the market. Everybody that was loving certain areas of the market were very expensive, and so it's probably important to make sure you're diversified and considering some of the unloved parts of the market to reduce the impact of the broader market downturn can have. Like in global equities, the market dynamic has shifted meaningfully during the first quarter, with international stocks surging ahead of U.S. stocks by the widest margin since the 90s. Weak expectations for international markets led to depressed valuations, setting the stage for this rebound and reminding investors that valuations do still matter. With the U.S.'s share in global market cap still near record highs, this reminder is now as important as ever. While many international economies continue to face cyclical challenges, sector trends are driving powerful returns. European and Japanese banks have awakened from their long slumber, and on the back of higher interest rates and fee income are among the best performing industries. Meanwhile, European defense and aerospace stocks have jumped higher on the back of an €800 billion defense spending package announced by the EU. China is still stuck in a cyclical bog, but its tech sector has seen strong returns due to better earnings and enthusiasm for AI innovation. Lastly, sectors that benefit from the growth of the emerging markets middle class, like Indian consumer discretionary names and European luxury goods, continue to appeal to investors. As seen on the left side of the chart, the dollar's recent decline has boosted U.S. dollar returns for a broad range of markets. Just as U.S. equities were overvalued, so was the dollar. Investors should be wary of how currency fluctuations can impact their international equity holdings. That can provide a headwind or a tailwind. Although investors have benefited from overweight U.S. equity in recent history, the tide can always change. And in times of increased uncertainty, investors can play defense by diversifying their equity exposure across global markets. Plus, an active investment strategy can help sidestep some of the riskier or lower quality companies and unlocking potential higher returns or better ways to protect to the downside. As stocks sold off in 2025, bonds rallied, and it helps soften the blow of a mixed portfolio, a 60-40 portfolio, which would be 60% stocks, 40% bonds. That said, with inflation, uncertainty still elevated, stocks and bonds remain, correlated over the long term. That means they move in the same direction. When this occurs, you want to diversify into alternative investments and alternative asset classes. So real assets shown towards the left, such as real estate, infrastructure, and transports, tend to be less correlated to traditional 60-40 portfolio or providing robust income. Private equity, venture capital towards the right could provide much higher total returns, but come at a higher correlation. So really in this period of unknown and where things are moving at the speed of a tweet, it's important to have broad diversification across a number of different areas, sectors, protections, really understanding what our risk tolerance is, what our time horizon is for needing this money, because trying to navigate some of this uncertainty is very difficult when it doesn't move at the traditional norms of economic data or market data. So we thank you all for joining us today. We hope you found this information valuable. Certainly reach out to us if you do have additional questions. We are providing additional resources on tariffs specifically. So please check out our website or our emails for resources on tariffs. And we're working through compliance to try to get a video out to you all on tariffs. And so hopefully we get that out to you soon.